Hey, it's Kristi, and in this video, I wanted to share with you the top reasons why I see people get declined for a mortgage loan application. There are various reasons why somebody may not get approved for a mortgage loan, but I wanted to share the top few with you that I've seen over the years on why somebody may not get approved. So very first is when we pull credit, you may have too low of a credit score. So the loan programs will have a minimum credit score requirement, and if your credit score is below that threshold, we may not be able to proceed, although there are ways to improve your credit, and that's one of the things that we'll talk about and work through to help get your credit scores boosted. FHA says on paper that it's 580 and higher, although a lot of the investors for the lenders really want to see 600. I saw that shift at the start of COVID, and most of my lenders have stayed around 600 or higher for an FHA loan. Conventional loans that are set by Fannie Mae and Freddie Mac, they really want to see 620 or higher. And if you're going for a USDA loan, they want to see 640 or higher. I also see where the credit profile or the most recent history isn't really solid. Sometimes it's because of late payments, recent collections and charge-offs, or perhaps a repossession. You really want to make sure at the time that you are applying for a mortgage loan that the most recent 12 months has on-time payment history for any obligations that you have reflecting on your credit report. Another reason might be because the debt-to-income ratio is too high. What that means is there's actually two ratios we look at. The first is your housing, and the second is your total debt-to-income ratio. So your housing ratio, a good rule of thumb, is that it should be about 1/3 of your income. So if you earn $4,500 a month from your job before taxes, deductions for insurance, 401k contributions, any of those things. So $4,500 a month, 1/3 of that equals $1,500. So we'd really want your housing payment to be at about $1,500. But what if you have really excessive debt? You have a couple of installment loans, a car payment, some credit cards that are all maxed out, maybe a bunch of student loans. All of those minimum payments, plus your housing cost, divided into your monthly income, will create your total debt-to-income ratio. Depending on which loan program we go with, it's usually somewhere between 45% of your income and 56%. But sometimes, even if your student loans are in deferment or forbearance, we have to use a fake payment on student loans for qualification purposes. And I've seen where using this payment on large student loans have kept some people from being approved. Another reason is a change of employment or because of job loss. So if you've recently changed jobs, as long as you have a 2-year work history, a lot of times the change of job doesn't affect your approval. However, how you get paid and how you are listed by that employer could change that approval. So let me give you an example. Let's say you have been a nurse for a year or two, and now you have become a contract nurse. I'm seeing that a lot right now because of COVID. So now you've got these short incremental contracts, usually about 3 months, where you travel to some hospital or some destination and you work there. And then at the end of the 3 months, the goal is to get a new contract and you go someplace else to work in, say, a hospital or doctor's office there. Because you are now a contractor and not an employee, the guidelines require that you are a contractor for at least 2 years. Now, if you are paid W-2 and you have several years of experience, we may have some compensating factors there to allow it. But if you are a new contractor or newly self-employed, that could get in the way of an approval. Typically, we want 2 years as a independent contractor or self-employed business owner. Now, if you went from working in a medical office to working as an assistant in a real estate office, no problem. It's okay. The only time you might have a problem is with an FHA loan. If you've had more than 3 jobs in the last 2 years, you would have to then be in your current job for 6 months prior to going into contract and starting that loan approval. Another reason I see is because of derogatory events. So what I mean by this is if you've had a bankruptcy, a foreclosure, a short sale, or a deed in lieu of foreclosure, there are time frames set up that we have to wait for a certain amount of years to have passed before we can go forward with a new loan application. If you have any back owed student loans that have gone into collections, they may have fallen off of your credit report because it could only be listed for 7 years since your last date of activity. However, if you still owe on a student loan, that could put you on the naughty list, which is called Kavers report. And if you wind up with a negative mark on Kavers report, then you may not qualify for a government-backed loan, such as an FHA loan. And to round this out, sometimes I see where there is a reduction of income or a reduction of hours. So let's say you used to work for your company that you work for 40 hours, but now you've been really tracking on like 30, 32 hours. That's called a decline in income. And when your hours or your wages decrease, we now have to get you approved based off of the lower hours that you're working. Now, if it's temporary, like let's say you're on short-term disability or you're recovering from a surgery or you just had a baby or something like that, and you're coming back short-term, you're going to be at part-time hours, but your goal is to return to the full-time work, and it's just because of this one particular reason, and it's for a short window of time. We can get around that. But if for the last couple of months you've been earning 30 hours a week instead of 40 hours a week, we're going to have to qualify you based off of that 30 hours a week because of the declining income from where it's been. Now, talk to your loan officer if this is a situation you might find yourself in to see if it's a temporary thing that you can work around or if it's something that's going to keep you in a lower amount to get approved for because you have to work off of those lower hours for qualification. Sometimes I'll see where somebody gets a new debt added. They've gone into contract and unfortunately they went to the furniture store and got a 0% interest on a credit card, or they went and bought a new car and their car payment is excessively higher than the one that they got qualified for. That new debt can actually keep you from getting approved. So that's why we want to make sure that if you are looking to get approved for a home loan, no changes to be made to your credit report. So don't go start any new credit, don't close any credit, don't go buying a new car, and please don't let anybody pull your credit. Really protect your profile and your credit as much as possible while you're getting approved for and closing on your loan. And until you sign those papers, you've wired your funds, and you've left the closing company with those keys, nothing is final. So please don't go to the furniture store the weekend before your closing and go and open up a new credit card and put your furniture purchase on it. You might wind up getting your loan not approved at the very last minute because of additional debt. And last reason, for the top reasons that I see that loans don't get approved, is because of the condition of the home. We get an appraisal, so you'll get an inspection that tells you the condition of the home, the age of many things such as the roof and your water heater and anything that might be wrong with the house. But the appraisal talks about the condition of the home and the value of the home. And it's really important because that's the collateral for the loan. So the underwriters are really going to want your home to be in livable condition, in safe and habitable condition. So that might mean no broken windows, doors that lock, a roof that doesn't leak, appliances that work. But let's say the condition of the home is less than desirable. It's not really safe and habitable to move into. That could keep us from getting an approval on that loan based on that appraised situation. So sometimes you'll see an appraiser write in the report, instead of the home just being the value it is as it is, sometimes they'll make it subject to. And what that means is it's subject to these things being fixed. I'll give you an example. If you have an FHA loan, it's really important that any exterior outlets has that plastic cover over top of it, that casing, so that way it doesn't get exposed to the elements outside and water when it rains. Anything that needs to be capped electrical wise. Let's say the seller removed a ceiling light fixture out of one of the bedrooms, but didn't put one of those metal or plastic caps over top of it, and you've got this, big gaping circular hole in your ceiling, and you can see the electrical. Something like that is going to be required to be fixed or repaired prior to having an acceptable appraisal. And so what that means is the appraiser has to go back out, verify that work has been done at an additional cost, by the way, and some extra time to update that report to show that anything that's listed on that subject to is repaired. If the sellers say, I'm not doing any of this, and you don't have the funds or the ability to make those repairs or fix those things that are listed, it might wind up where your purchase doesn't get to closing. In most cases, I've seen, almost all cases, honestly, that I've seen where everybody kind of comes together and makes it happen so that we can close successfully on the loan. But you may not want to move forward or even get to the appraisal stage based on the inspection report. If you find out your home is a money pit and some things that are really expensive to repair or replace are on the very end of their economic life, and the seller is not going to do anything to replace it, repair it, upgrade it, you might want to walk, which means canceling the contract on that purchase and moving on to find your next home, the home that's meant for you. Anyway, I hope these give you some ideas on why some loans don't get to closing or why some people don't get approved. And if you have questions, feel free to reach out to me at questions@creditkristi.com. I'd love to answer those for you there. Thanks for watching.